there. Now, we talked earlier about the retailer Spar, their results. We described them as solid, but perhaps disappointing in terms of market expectation. 12% rise in interim headline earnings per share to 342 cents. The retailer also reported a 9.6% hike in group turnover, 23.8 billion. Now, joining us on the line to unpack these numbers is Wayne Hook, the chief executive of Spar, speaking to us from Durban. Morning, Wayne. I put it to our panel this morning that these looked like solid results and a dividend of 179 cents a share, up 15%. I think investors would be happy with that. And Viv Govender was saying, well, yes, but the expectations of this sector now are so high that some will be disappointed. And I know you don't want to talk about the share price, but it was slightly down this morning. So perhaps take your view of your company's results.
Yeah. David, I think probably reasonable in the circumstances was about what I'd comment on. I'm not doing flick-flacks about it. It is a challenging environment, and I think twofold. One, on the consumer side, we've all heard about it before. In the early part of the year, certainly the strikes and all that sort of thing that took place had an effect on us. But the consumer's under pressure. We all know that, and under increasing pressure. And it is competitive out there in terms of scrapping for market space, for sites and that sort of thing. So all the sort of stuff that we know about. So when I look at our business, and I sort of say on the food side, our existing stores, which is always the guts of our business, the important part, and I look at what else is happening in the market out there. They grew at about 7.88%, not bad in the circumstances. And so that's sort of an important, let's call it, measure for us. Probably where we've had more pressure is on the building material side, where we've rollicked along for years, and that has certainly slowed quite markedly in the last sort of 4 or 5 months. That's been a fact. That Tops just continues to power along. So yeah, it has been a tough trading period.
Yeah, that building materials area, of course, Cash Build also operating in that area. They had recent results where I think it was their revenue or their earnings just up by 1%. So clearly that sector is really slowing down, and that social wage, the social grants that were said to be providing a lot of that business faded a bit. You mentioned Tops, that's your liquor outlet. You said that's strong. Is that increased market share? Because in my mind, as a consumer, you seem to have put more emphasis on it. I'm more aware of it.
Yes. Well, I mean, I think as we grow in numbers, so the brand becomes more of a force. I mean, we put lots of emphasis on it in our mind over the last 10 years, and that's why we've grown to the number of stores that we have, 560 odd of them. So, it's an important part of our strategy, and in total we grew at retail somewhere in the region of 18% there, so very strong. Yeah, and our existing stores about 11 and a bit, so the balance being obviously the new stores that we've opened. So yeah, that was a very solid performance.
Yeah, interesting point you make where you talk about consumer spending. You list the usual reasons. A lot of people are unemployed. It's energy costs, transport costs, adding to consumers' burden. You talk about less credit being extended, and we were saying on the panel earlier that the sad thing and the dangerous thing is that a lot of people are buying their basic necessities, the groceries, from people like you on credit.
Yeah, well, yeah, I mean, it's sort of not something that we encourage, obviously, but if someone comes in with a credit card and they've got, you can't stop them.
Yes, I think what I'm saying, Wayne, is that it does tell us something about how tough the market is and about the prospects for retailers.
Yeah, no, absolutely. And I think, for me, the concerning thing is one doesn't always have a handle on this unsecured situation that sits behind it. When it's stuff that goes through, let's call it the more formal channels, for want of a better word, then it's a bit easier to monitor. But I think people have really maxed out to some extent, and so that's not good. Yeah.
And just finally, these are tough times, as you've said. You're not doing flick-flacks, but they reasonably solid. But you're still expanding, so you're still growing. And what's your plan in terms of expansion for the next year?
Well, again, the thing that always works for us is that upgrading of existing stores. As I say, for us, with our sort of model, it's our existing stores that count. So that organic growth that's crucial for us. So upgrading our existing stores, we will open stores. We will not open stores indiscriminately. Our retailers have got to make money into the future. They can't sit around for 5 years losing money. So we will open stores, but probably on the Spar side, maybe 10 to 15 stores. But then when you add build it, another 15 or 20 and build it, you say, and then on tops, also another 15 or 20. We've got some pharmacies, 10 or 12 of them, some Save More stores. It adds up to 60 stores very quickly, So there obviously is an important aspect. So I think those are the major areas. The Africa thing, which is the flavor of the month, we are going slowly and carefully, looking at some options there. We're already in Botswana, Namibia, Swaziland, Zimbabwe, opened a few stores in Mozambique in the course of the last 18 months, got 4 Spar stores, a couple of build-it stores. So, we'll take that step by step.